Are you currently buying a multifamily project in Alberta right now? If you are, stop a second and watch this video. We're going to explain all you need to know about the risk associated with actually purchasing one of these properties with the MLI Select program. Hey guys, Josh and Aaron back for another Finance Friday, and today's video is something that is near and dear to Aaron and I's heart. We've been pretty open about these CMHC purchases that are happening specifically in Alberta and how your equity position, your down payment can be affected based off of a handful of different variables. So without further ado, let's dive right into it. Most of the people who are purchasing or using the MLI product, predominantly before, I guess, this year, they were using it for multifamily purchases. They were using it for refinancing stabilized multifamily buildings. And like all investors do, we find creative ways to use different products. And that's exactly what is happening. There are developers in Alberta that are selling spec multifamily properties. Usually, they are side by side, either duplexes with an ADU in the back. And what they're doing is they're having multiple lots, and those lots allow for a combined unit of over 5. So, you'd have 3 and 3 and 3, you could have a 9-plex, and you could qualify with the MLI product at 95% loan to value. Most of the time, people are using the points from the affordability because the affordability metric is here and the actual market rent is here, or they're adding some sort of energy efficiency and the developer is building the project to that level of energy efficiency. What's happening is people are acquiring these assets with very little money down, but don't always understand the risks associated with what could possibly happen throughout the term of submitting the loan to actually closing on the loan. So we wanted to make sure everybody was aware of this.
Obviously, one of the big factors here is going to be where your interest rates land up. So if you've ever gone through a CMHC deal, you understand that when you get your LOI out initially before you submit it to CMHC, you don't get a locked-in rate. You get a spread above whatever the bond is going to be at that time. Could be 55 bips, could be 100 bips, 120 bips, 65 bips, whatever that is, but your spread is always going to be some sort of variable above wherever the bonds are going to be. And then up until the day that you rate lock, so you could be 3 months down the road, you are exposed to the bond market. So if you get an LOI at a 2.88% 5-year bond, in February, but then, come May, your 5-year bond is up at 3.2%, well, that 40-ish point spread difference gets added to whatever that spread that lender's giving you. Now, we can't obviously control these bonds, and especially in a market like today where we have tariffs and economic uncertainty in Canada, we don't really know where these bonds are going to be going. Obviously, we're projecting them to kind of stay low, but things can change very quickly. Come time of closing, if the bonds are higher, well, then it is going to require some capital to be injected. Essentially, what is basically done as like a buy down of the bond. So, depending on where your ceiling rate is underwritten at and how aggressive your lender or your mortgage broker is being, it does potentially expose you for greater differences in the bonds come time of funding.
Yeah, and essentially what happens is if you are committing to a 5-year term or a 10-year term, depending on what bond you're looking for, that difference from what your max rate was or what we submitted the loan at versus what your actual rate is that you lock in, you're responsible for that additional difference. So that 5% down that you were expecting to make, if the bond rate, your locked-in rate is higher, you have to make up that difference for either 5 years or 10 years. And depending on the loan size, a few $1 million, that could be an additional 6 figures of additional capital you need to bring to the table to be able to close on your deal on top of the 5% you've already allocated to the purchase. This isn't something that is necessarily known at the time of funding. And what we can do on our end is take a look at where bond yields are at today and make an educated guess in regards to the leverage you're looking to take on what the projected net operating income is going to be on the building, because realistically you don't have tenants for this yet. We need to be able to rely on the appraiser and market projections to be able to understand the projected net operating income to give you the ability to be able to close on this. So, choosing what type of bond and the length of bond is going to also determine that buy down potential and essentially risk you're taking on when looking to lock up one of these buildings. One of the negative aspects of submitting to CMHC and the entire process in and of itself is how long it takes to actually submit the file. As Aaron stated at the start of this video, it opens you up to a level of exposure from the time you submit and you lock up this purchase and sale agreement to the time you lock in your rate. And what that does is it not only does it give you bond exposure, it also opens up exposure with the market in and of itself. And when you have an economy that is consistently changing and right now rapidly changing, it's important to understand the dynamics of this market and how it's going to affect certain aspects of your purchase, such as vacancy. Historically in Alberta, we've had high levels of vacancy. Only the last few years, when you've seen people immigrate to Alberta, we've seen that vacancy start to drop significantly. But what's happening right now is these developments that were sold, let's say 6 months ago or a year ago, to investors, they were projecting rents that were absolute top end of market rents. Market rents that you could have achieved back then, but now when you're looking to close are no longer viable. And when you're looking at economically where Canada's going, we're going to have negative growth for the next 2 years. It's statistical. Like, we are not bringing any more people in the country, and we're going to have a net outflow of people in our country, which is going to increase vacancy in multifamily buildings and rentals. What's happening is the projected rents on these projects are no longer hitting what the projections were. When it's time to close or time to lease up, your net income that you projected isn't meeting the debt servicing ratio we submitted the file at. Now you got one of two options. It really depends on the underwriter that you have. On a smaller project, they might not require lease up. If that is the case, you have EGI not met and you close the file, but you have an insurance premium increase on your loan. Alternatively, you have lower rents and you're no longer able to have the leverage that you were able to when you submitted the file, which requires you to have a much larger equity position than what you normally anticipated when you locked in the deal. All things to keep in mind when you're looking to lock in one of these properties.
Yeah, and even just the season of when you're pricing out your rents versus when you're actually going to find tenants. If you speak to an appraiser during peak rental times in the summertime, they might be $100, $150 higher than what you might actually get if you start leasing out your building come wintertime. There's just not many as tenants. People don't want to be moving in the winter time, so you have to bring down those rents a little bit. On a large building, you might be able to offset that, but on the smaller buildings, if you have 8 units and they all come in $100, $150 less a month, that can drastically change the ability of your building to qualify for that same loan. So that yearly risk that we've had from when immigration was higher to now when it's going to be decreasing, and that project timeline exposure, but also just from when you first get the appraisal and your expected rents, and then depending on the season that you go to actually rent out, there can definitely be some rental shifts there.
Yeah, and I think another risk that people aren't taking into consideration right now is you now have entire developments that are for rent. You no longer have an apartment building here or a few apartment buildings that are in the middle of a gentrified area of houses. Every single one of these properties are going to be rentals. Certain demographics are going to live there, and when economic pressures start to come to investors, they start to drop rents. One person drops rents, everybody starts to drop rents very quickly in a localized area, which could put downward pressure on the rental achievement that you're looking to take. So we're seeing definite softness in rents, and we project to continue to see that. So when you are underwriting these deals or you are looking at these deals, make sure that you are being conservative when it comes to the rental projections that you're expecting. Or when we're looking at it and we're going to get an appraiser to give us their opinion on it, we're going to try to be conservative just to ensure that you're not riding that 95% 1.1 debt service 50-year amortization, because you have no give at that point. You have no more ability to be able to have any wiggle room if rates go up, if vacancy goes up, if rents go down. You are essentially hoping that the entire market stays stagnant until you close, which in today's world isn't viable.
One last thing touching on the rent aspects is as Josh is about to talk about some policy changes, but the newer policy change for MLI Select, which is adding in the rental achievement. Rental achievement was always a policy and underwriting tool on the MLI standard side, but on the MLI Select side, one of the benefits was that it did not have rental achievement when it first came out. Obviously, given the softening of rents and what I believe is also just the aggressiveness of rents being submitted in on a lot of these projects as well too, CMHC has brought that rental achievement on to the MLI Select side. So what that means for purchasing new builds, but also on the construction side, is that CMHC is not going to fully advance your loan to you until you've met your EGI, your effective gross income. What that means is if you're buying a property, and even though the property may qualify for 95% loan to value, if on that new build you don't have that full EGI met on the day of closing or when you're finalizing your loan with the lender, you're going to have a rental achievement holdback. So they're going to hold back the loan beyond probably 75%, which means on closing you're gonna have to come up with at least 25% of the down payment, again, because they're only going to give you 75% until you've hit that rental achievement. So depending on how quickly you can get that lease up done, you may be in a position where you have to front more closing costs than you were prepared for. So when you're getting into these new builds, purchasing the new builds, again, be prepared to potentially put 25% down, even though the building may qualify for 95%. You just have to put that capital in up front, prove to the lender that you've got your leases in place, and then you'll be able to move that rental holdback back into your pocket.
Yeah, and historically when we're looking at some of these purchases, we're looking at like $2.5 million, $3 million. 20% on that is $600,000 that you're going to have to come up with instead of the 5% that you were sold. So this is actually a policy change that came into effect recently, and we've seen it on a lot of larger projects, and they're kind of towing the line moving forward. Some files that were already submitted aren't necessarily subject to this, but I would expect moving forward that CMHC is going to start to require that rental achievement holdback. So if you do have one of these under contract and your file isn't submitted yet, understanding the liquidity required to be able to actually make this transaction happen with the higher leverage and what is going to be required from a rental achievement is probably the largest variable that you could possibly take into consideration when buying one of these buildings. Additionally, if you have gone through CMHC or if you watched any of our videos before, as you know, CMHC likes to change their policies, which seems like monthly. I heard they're trying to narrow it down to twice a year, but there are some rumblings in the market. It's not official. It is not an advice yet, so don't take this as law, but there are some developers who have been selling small multifamilies, let's say like a home or a duplex on a single lot, and then another detached duplex on a single lot, then another detached duplex on a single lot. And CMHC has been pausing essentially the processing of these properties because they aren't going to allow you to use the MLI product because really these properties are residential properties. There isn't necessarily some advice, like official advice yet, but the risk of policy changes just in and of itself is an inherent risk when looking to take on this type of debt. If you are going firm on a deal, on a multi-million-dollar deal with 5% down, and you don't have the additional 20%, or you haven't run your numbers on what does my debt servicing look like when I don't qualify for CMHC MLI Select, and what does it look like when I only have to qualify for CMHC standard? We think that is an inherent risk that you need to take into consideration, and I highly recommend when you are looking to acquire one of these, look at what the bare minimum of CMHC standard 5-year debt is and what CMHC standard 10-year debt is. Your debt service at 1.2, your debt service at 1.3, you have a 40-year amortization. You should feel comfortable with deploying that much capital at a minimum when taking on one of these projects in case CMHC decides to change their policy decision, because unfortunately every single time a policy decision has been made, there's always been somebody on the other end of that policy decision holding the bag. And usually, historically, those have been well-capitalized developers who acquire multifamily assets and hold them, not retail investors who are purchasing multi-million-dollar properties with 5% down. So, Aaron and I wanted to make this video to ensure that everybody understood the risks associated with acquiring this type of debt. If you guys do have any questions, or you have any concerns, or you want to chat about what your options look like, Aaron and I are always available to discuss this. If you did like this video, hit the subscribe button, hit the like button. It allows Aaron and myself to make more videos like this for you guys. We appreciate your time.